Welcome back. Fifi Pease is still with you as we continue to unpack the reaction to the medium-term budget policy statement that was delivered by the Finance Minister, Tito Mboweni, a little earlier this afternoon. And what we have seen is the rand continuing to weaken against the dollar. That number there up on your screen. So we have officially breached that 15 rand mark to the dollar. And that's as a result of that medium-term budget policy statement showing that South Africa's deficit was rising very sharply. And to discuss the outcome of it all, I'm joined by Adrian Saville, the Chief Executive of Candid Asset Managers, Maarten Ackerman, Chief Economist at Citadel, and also Anthea Gardner, Managing Director at Cartesian Capital. Thanks so much for your time. Now, obviously, just judging by the reaction of the rand, that this budget, it really missed expectations by quite a long mark. I'm interested in what you went in thinking and hoping that the Finance Minister would say, and how far and how different it is from what we actually do read. Adrian?
What I was hoping for was no poetry and just calling it as you see it, or calling it as it is. We're done with the poetry, we're done with the storytelling. And South Africa is in a very tough place. We are in a fiscal straitjacket. And I think the two places to go to for sort of the reading of the tea leaves on the medium-term statement would be the bond market and the rand, as you point out. And the rand went the wrong side of 15, and the bond market went from 820 to 840. And in sympathy, equities, especially banks, went softer. But it would be the rand and the bond market that, to me, call it as they see it.
Because just to put it into perspective, I mean, there is some commentary saying that, we had US GDP numbers come out and the ADP numbers come out and the dollar's a little bit stronger, and therefore that's why we're seeing inflated moves in the rand like this. Maarten, to what degree does that apply? And to what degree is this all the fact that, the budget is a lot uglier than what was expected?
No, I think, the rand strong movement happened just after the minister started speaking. So that's a clear indication that, it's local issues more than offshore issues.
All right, you mean the weak movement?
Yes, yes. So the rand started moving quite weaker just after the speech started at 2 o'clock. So that's definitely a local issue more than anything else. And as he continued speaking in terms of, the state we're in terms of the debt trap that we're likely to see if we're not doing anything very soon. So again, done talking, start doing, I think is the next move. So I think the rand for now is clearly local issues more than anything else. It's funny though that if you look at the rand longer term, we've had 15 last year October as well. So compared to the longer term history, it doesn't feel that bad. But I think from where we're coming from, this is a clear indication from the market that if we continue down this road, it will cost us in terms of interest rates and also capital flight and weaker currency as a result.
I mean, Anthea, your take and your impressions on the numbers that we did see, how far removed they were from your expectations, and if, the moves that we are seeing right now is a function of the market and investors saying that, a downward move from Moody's is a done deal at this stage.
So I thought that the Finance Minister would certainly try and sort of plaster things over so that when Moody's came to the table, he had something to say to them. I was expecting a lot more talk about policy change and something to make a difference. The numbers that shocked me was the debt to GDP ratio. Because I sort of looked at it and thought, well, okay, we can expect a 60% debt to GDP. And in fact, Moody's had previously said they'd be okay with it. They were kind of expecting it. But when you put in a 70% of debt to GDP by 22-23, okay, so it's 2 or 3 years down the line, but the trajectory is exactly in that direction. And then on top of it, mention over 80% by 2028. Suddenly I go, oh, IMF bailout, that's kind of ridiculous territory. So my hope was that it would be a change of trajectory of where we've been, but actually it's not. It's completely in the same direction. And we just have not seen anything positive or strong enough to change things. So you really need, I think we're on the precipice, and you need absolute hard talk about what's going to happen. So to be honest, I don't really care about a limit on government officials' car allowances and that sort of nonsense.
That's if they take it.
Exactly, right? Oh, and retirement, 4,000 early retirement. Who cares? That's not going to make a big difference. And then the other thing that shocked me was using the words Eskom and debt relief in the same sentence, because I think that is huge. We all know that Eskom is a problem, and we all realize that if we take the Eskom debt onto the balance sheet, then we really are hamstrung and in a debt trap, as Maarten said. And so those were my kind of big shocks for the day.
But they did mention Eskom, or jump in there.
Just before we go away from Anthea, she's saying, before we take Eskom onto the balance sheet, I love the way that the pretense is as if Eskom debt isn't on the balance sheet.
Sure.
So when you take state-owned enterprises and municipal debt, you actually add another 15% to the debt to GDP ratio. So
on top of this projected 70 to 80.
Correct. So in reality, when they're talking about us hitting 60 at the next budget, it's really 75. So we're in that runaway debt territory already. And you see this in the growth and expenditure items. By far now, the fastest growing expenditure item is debt servicing.
He even mentioned, the finance minister, to say that if we continue on this current path, servicing debt will cost more than spending on health and economic development. And they mentioned...
There you have it.
And we need health and economic development. And Anthea mentioned the issue of the IMF, and I'm interested in your views on Moody's, how the conversations are going to go down today, because the DG did tell us that shortly after the budget that he would be speaking with Moody's as Treasury. So Moody's and IMF, how do you see that playing out?
Well, Moody's won't downgrade us. They'll move us from stable to negative. And I'm not saying that they will do that on the 1st of November, but if they are to make a move, it wouldn't be a downgrade, it would be a move from stable to negative. At the moment we're at stable, and then from there the next move would be the downgrade. So there'd be a last warning.
For me, it was as if the minister today, warning shot was fired. It was almost as if he tried to speak to everybody else from Treasury point of view to say, listen, this is unsustainable. And he said, well, if there's no policy reform, it's almost as if he wanted to warn everybody that's pushing against policy reform to say, well, if we continue down this road, it's doomsday scenario. And he's almost passing the baton to others to pick that up, whether it's politicians or the Eskom new management. So they're not really taking responsibility for that. He just said, well, on this path, it's not going to happen. We need to do something. In terms of the ratings agencies as well, I think, Moody's, it will almost look foolish for them to downgrade us now. They gave us so much time, and now that there's almost a plan and we're just ready to go from poetry to implementation, this will be the wrong time to do it. But I think this is the last time that they'll give us the benefit of the doubt. In fact, if we don't see results by February, I think they for their own sake, they probably will need to.
But February is just.
No, it's around the corner.
It's just there. And you'll be talking about the poetry. He describes South Africa's economy as being, resilient. Or we try to use the analogy, the aloe ferox plant, which is resilient. And, the worst of the 10 years is over. And now here's a plan that ultimately gets us on a better growth trajectory. So next week, President Ramaphosa is going to stand before investors and say, please pledge to South Africa. Pledge your monies because we are open for business. Come through, you'll get returns. How is this a budget that would provide comfort to companies to deploy capital in this country right now, Anthea?
Exactly. So in the beginning of the speech, he mentioned economic zones and he talked a little bit about policy change, but he really did not put anything substantial and tangible on the table. And Maarten's so right. He literally passed the baton. He went, so I'm really struggling. I don't see how, if I raise taxes, is going to make any difference. Edward Kieswetter, please, can you go and collect them? It literally did that. So I think I don't see how this speech was going to help raise the $100 billion that Ramaphosa is trying to raise. And the point is we do need investment. We need infrastructure investment. We need foreigners to be invested in our economy, not just flighty money, so it's great that we raised $5 billion in Eurobonds a while ago, but even that actually is an issue because as he spoke, because we'd raised it in dollars, by the time he spoke, servicing those Euro bonds suddenly was 2.5% more expensive in an hour and a half. So it doesn't really help us with this language and not doing something tangible. We really needed very hard lines against where and how, and it just didn't come. He really missed his opportunity.
Because the guys behind Stain City have recently, in fact, today they announced that have invested 5.5 billion rand, a further 5.5 billion rand on top of the 6.5 billion into that project to further develop. And so they say, no, we're buying into hope, and we're taking a glass half full approach. Do you see the likelihood of other investors following suit and seeing, you know, through the wire, hashtag Kanye West, and into those green shoots?
The big call is for foreigners to, you know, allocate this $100 billion, and in the greater global scheme of things, that's a rounding error. That is, if you're a robust economy, that's a number that's easily achieved. I think the telling number is if you look at the outward foreign direct investment from South Africa, that it is South Africans sending money elsewhere at a pace far higher than foreigners are sending money here. So we've got a net leakage of domestic capital going to fund investments elsewhere in the world, many of which have been very sorry adventures. That's a story for another time. But the confidence is missing. And a medium-term budget policy statement is not really about big moves in policy or shifting tax rates, but here is a chance to instill confidence and embed the message. On this score, I'm a fan of Mboweni. You know, what I think is comes from that 77-pager is doable, it's realistic, it's pragmatic, but no more talking. Let's just get on with it.
Sure. Because, I mean, just to add on to the question about investments flocking in come next week, and maybe some of these multinationals, maybe not the South African investors, taking the viewpoint that, hey, the minister mentioned the fact that Ethiopia is growing at like 7%, and Ghana is growing at like 7%, and Kenya is growing at like 6%. Maybe come to South Africa, set up shop, use it as a springboard to go and tap into, you know, this fast-growing economies in the rest of the continent. I mean, could that be a pool?
Yeah, it can. You know, I think the medium-term budget is just an update to say this is where we are right now. And I think there, you know, the fact that the minister didn't lie about anything, although the numbers are looking bad, at least that should bring some confidence to say, well, we're calling a spade a spade. You know, it is a bad situation. The only thing that can save us is growth. And one of the most important pillars to get growth going is investments, local and foreign. Now, since beginning of 2018, if you look at foreign direct investment as percentage of GDP, you know, we're now rebounding 3 times faster as GDP. Now, we haven't seen that since the early 90s. So it's early days, but typically, you know, if you see that foreign direct investments are running away from the growth in the economy, then in the next 3 to 5 years, you've paved the way for much stronger economic growth. So on that front, you know, if we go back to his economic plan, if we can just implement 50% of that and stay on course, then we can actually slowly get to fixing this economy. But it is going to take some time. Because
I asked the question to earlier panelists about that implementation. Even if it's 50, you're saying if we just do the average in terms of implementing, then maybe we can see the needle move. But leopards, do they change their spots? And we know we're not good at implementing, we're good at the planning part. So, I mean, how confident are you that this time around we might actually, you know, change and do the things that need to be done?
I'm afraid I'm not very confident. I'm with you on this. You know, I think, sure, how many plans have there been since 1994? I think it's like 7 or 8 different plans. Finally, this is, you know, there's another one after the new development plan or whatever it is. But yeah, what can we say? It's time to get on and do things, and how you do it is probably the key, right? But confident I'm not, I must say.
And how you do it as a president who is, you know, facing, you know, fractional divisions within your party, and whereby not everyone is on board. I mean, even the finance minister's growth plans, not everyone is on board with how you think that this economy can go forward. How do you do it?
I think he's getting more and more on side.
Okay.
And the one thing we certainly know about the president is he plays the long game. You know, that much we know. If you look at the sort of key appointments today versus 12 or 24 months ago, I think South Africa is a substantially stronger place than it was a year or 2 years ago. And we don't want to lose sight of that. Add to this comments that Maarten makes about the investment impacts that you would start to feel in a couple of years. It doesn't change the importance of getting from beautiful policy documents into implementation, but he's calling it out. He's telling us Eskom is a business, it must be run as a business.
Sure.
SAA is unsustainable in its current state.
Sure.
This is strong language. It's clear language.
But, Adrian, you once spoke with my colleague, Karabo Letlatla, about political matters on his show. And we were talking about, you guys were talking about the ingredients that led to the Arab Spring and how there are similar ingredients here in South Africa. And we have seen the successive bouts of xenophobic attacks. I mean, even today, happening in Cape Town there as a result, one, of the frustrations of South Africans in not having jobs, you know what I mean, in being unemployed. And this is the result of the fact that we're constantly being told it's a long-term. I mean, how long is long? And do we not expect incidences like this as a result of the frustrations of the people on the ground to continue to rise?
I personally think we're running out of time. So, I think the next 12 months is make or break for SA. This will give us the opportunity to implement some of these reforms, to at least get growth in line with population growth, because we're still below population growth. The minute we can do that, then at least we can stabilize the increase in unemployment rate. That is achievable. We can do that in the next year. So we need to take small steps, but I do think in time we can do that, just to stabilize the social environment, prevent unemployment from increasing further, and then address some of these issues to hopefully get growth going. Again, I think, the minister, this wasn't really a political budget, because he said exactly what he wanted to say, and he almost pointed fingers to some of the other departments. The challenge is now that by handing over that baton, in terms of, again, the implementation, will some of those factions be willing to make the hard decisions? He was quite brave to almost highlight the elephant in the room, which is the wage bill. But it's not him that's going to make the decision in terms of, not giving salary increases or, in fact, reducing the headcount. He's handing that over to some of the politicians. And that's where we need to see the willingness to really make a difference. And that's why I almost think, again, like I've said, he almost warned the rest of the country, including all political parties, all government institutions, all public participants, that we can't continue down this road. And if that means that we need to take salary cuts, which is pretty much the same as taking a higher tax rates, we need to do that to actually get onto a more sustainable road going forward.
We saw how that played out when they tried to do it at Eskom. Yeah, not very
exactly,
well.
Yeah.
But
how going into an election, perhaps put that as a as a qualifier. But of the three common ingredients to the Arab Spring countries, young, unemployed, unequal, South Africa is abundant in these three characteristics, which is why the work that, what my wife is doing at the Youth Employment Service.
Declare the conflict of interest.
There's the conflict of interest, is so critical. And it points to, on top of Maarten's growth, the importance of restructuring. So if South Africa gets 2% growth, we might at least then get into a holding pattern on unemployment. But alongside that growth, I would argue even more important is the restructuring so that the growth becomes labor absorptive.
I mean, the CEO of Business Leadership South Africa, she was very, unscathing. Correct me there, please. English sometimes is not my tongue mother.
Scathing.
Frank.
I think she's good.
Frank in her, frank in her, her description of what has happened in trying to do some of this restructuring and reorganizing at state-owned entities, whereby you have got the interference of the main shareholder in trying to make the tough decisions, but the main shareholder says, no. So in terms of the restructuring that you guys are talking about that needs to happen, that I'm sure might happen,
But let's be clear, the restructuring is not just public sector, it's private sector also. And perhaps even more importantly, it's private sector. Because industry after industry in South Africa is characterized by a small number of large companies.
Yes.
So when the economy grows, it tends to be concentrated growth that sits inside of these small number of large companies. What we're missing in action is mid and small-sized businesses. That's where jobs are created. That's where you're going to get the absorptive growth from.
How do you do that? Because the NHI bill, not much was said. It was just mentioned that, you know, they're talking about it. But the NHI bill, and I believe also the health market inquiry report that did come out, is something that seeks to address the concentration just there in the health space. But then, you know, the reaction has been it's not investor friendly.
So one of the short term, he had 4 things that he said we need to do in the short term to get things going. And one of those were small and medium enterprise registering and red tape around that and filing for taxes, making ease of doing business, make it easier to do business. So if we can do that, that will certainly help in kickstarting that part of the economy. We also know that small, medium business, that's really where you create jobs. Not the same as the big ones, but the turnover in terms of creating jobs are so much bigger. So I think how we do that is providing the right incentives and removing a lot of the red tape, which seems like in this budget it is part of this shorter term plan. Also, maybe just on that, the one very positive that he did mention was this whole thing about tourism. And I still think that's one of the low-hanging fruits in South Africa, because we've got so much to offer from a tourist point of view. Yet, if you look at that industry as a percentage of our GDP, we rank at the lowest compared to other countries in the world. We don't need another ESCOM to do that. It's not energy intense. And for every tourist that arrives here, I think you create about 7 to 10 jobs. So, you know, for government to really focus and target certain industries, and I'd always think about what is the big plan that solve all problems. We can easily get traction, and in a year's time or so, you know, get some proper results in terms of creating jobs in other areas where they never thought that we might actually create jobs.
Sure. Anthony, I was speaking to a fund manager earlier, and he was talking about the performance of companies, sort of your rand hedge stocks, you know, that make most of their money outside, and saying that, you know, for the past 6 years, consistently they had beaten the performance of domestic-based stocks. So if you're an investor right now and you're looking, watching CNBC and asking, you know, Anthea Gardner of Cartesian Capital, in terms of allocating my money after this budget, what should I be doing? Should I be investing in South African companies at this stage, or should I take my money? I can't physically leave. It's a bit hard right now, but my money can.
Sure, I find this conversation quite difficult because I've managed equity money, but I think that is probably not the right place to be. You know, I think you're probably looking for safe haven assets rather than the riskier shares or companies that are listed on the JSE. From a point of companies that are already generating revenue offshore, it's another difficult one, because as you've seen in the last, 12 to 18 months, even those companies have come a cropper, right? And not through necessarily their own faults. Some of those companies are particularly good South African companies, Mediclinic comes to mind, and through no fault of their own, they've expanded, but then had the rug pulled out from under their feet because of a change in regulation, for example, or a change in the way the consumer is reacting. And also we are facing global headwinds, right? Where there's no doubt we're at a late stage in the economic cycle. So I would say be cautious, be on the safe side, or play on the safer side of the asset pool, rather than trying to find these rand hedges that are going to do so well because we expect the rand to blow out.
In some parts of the world, US equities come to mind, look very expensive. So you want to be careful just rushing offshore.
Because it's even more expensive now with the rand at 50.
It's tempting in South Africa to be buying shares at the moment because they do look so cheap. But I'm not sure what the catalyst is for these shares to rally. So certainly the banks, wow, unbelievably cheap retail stocks. But what's going to get them higher is the question.
Final thoughts on this budget, and also just a brief outlook as to where South Africa is headed. Where to from here? Adrian.
Economically, sadly, I think it's stuttering. That what we really want is sort of a rebound into rapid growth. It's hard to see that based on where things lie at the moment. What we can take confidence from is the strong institutions, the strong financial sector. We've got deep pension pools, robust capital markets, and I would take confidence and courage from those. And the fact that South Africa is a potentially very viable recipient of substantial global capital under the right leadership. If we get a couple of things right, 12 12 months' time, we could be having a very different conversation. Not a miracle conversation, but one in which confidence and resilience are evident.
Sure. Maarten?
Yeah, I don't think it's game over yet, so I'm still very hopeful. You know, if you look at our 3-year growth number, so just try and look a little bit longer term, we're sitting at about 1.3, which is not great. But you know, back in the end of the 80s, beginning of the 90s, for 3 years, we're growing at -2% per annum. So it's a very different environment we're in right now. So if you think about this fear about getting an IMF bailout, you know, Venezuela, they're standing in front of the IMF and they've been growing at -4 for 5 years. So we're not there yet. So I do think, and that's why I'm saying it was almost a warning bell today from the Minister of Finance to say, guys, if we don't start doing something right now, and it's the same policy, then we will end there in the next 3 to 5 years. But we do have some time, and so let's all get busy on the doing side, and then we can get there.
Sure. And then?
So for me, what we really need is a cut, an absolute break in this trajectory. Everything's going the wrong way. Debt is getting more, spending is increasing. You need a real, you just need something that'll change that. So something quite harsh. And all this talk of the Arab Spring, I was in fact living in Tunisia when it happened, and it reminded me of something else. Actually, this little, what was it, R1 billion that he gave to the NPA. I'm always going to sit back and watch how this plays out and see what he's going to do about it, because that was one of the other issues with the Arab Spring, or in Tunisia at least, is that they had politicians that were corrupt and stealing from the man in the street, and the man in the street just got fed up, really.
Sure.
So I feel like slowly, but can we stop playing around the edges? It's time. You know, it's time for a big break now.
Less poetry, less feeling like I'm in church on a Thursday. What? The constant references to the book. But nonetheless, yeah, thank you. That's where we leave it for the post-budget analysis of the mid-term budget policy statement. I mean, really, it's not game over. It's not all doom and gloom, but there's a lot of tough decisions, and there's a lot of implementing that will need to take place for us to be this time next year sitting and looking at a better picture of South Africa. But thanks to my guests, Dr. Adrian Saville, the Chief Executive of Candid Asset Managers, Maarten Ackerman, Chief Economist at Citadel, and also Anthea Gardner, Managing Director at Cartesian Capital. From us here at CNBC Africa, thanks so much for watching. It's bye for now. Closing bell, West Africa is next.